So, you want to own a credit card company. Everyone who has ever paid interest on a credit card thinks they understand this business. The bank lends the money. The borrower pays it back with interest. The bank profits. That is the entire model. Except it is not the model. And the companies printing the most consistent profits in the history of financial services are not banks. They do not lend a single dollar. They do not carry a single dollar of credit risk. They have never, in their entire history, been owed money by a single cardholder. Visa processed $2 trillion in transactions last quarter. They collected around $3 billion for doing it. They did not touch the money. They moved the message, the instruction that says the money should move, and they took their cut before anyone had time to wonder if it was fair. The company that owns the rails does not need to own the train. What you have to decide is whether you want to be the bank or the railroad. There are 3 ways into this business. They do not look like the same business until you understand the mechanism. Tier 1. You buy a small issuing bank, the institution that actually lends the money and puts the Visa or Mastercard logo on the card. A community bank with a modest credit card portfolio runs between $40 million and $150 million to acquire. You are now in the credit business, not the network business. You take the lending risk. You make the interest income. You pay Visa or Mastercard for the right to use their rails. This is the entry-level position, and it is genuinely dangerous if you do not understand consumer credit cycles. Tier 2. You acquire a mid-sized card issuer, something like a regional bank with $2 to $4 billion in outstanding card balances. Purchase price runs between $200 million and $800 million, depending on portfolio quality and charge-off rates. Capital One was this business once. So was Discover. At this scale, the lending risk is existential. When unemployment spikes, your charge-off rate spikes with it. The 2008 financial crisis wiped out 3 card issuers at this tier in 14 months. Tier 3. You buy into the network itself. Visa went public in 2008 at $44 per share. That same share is worth roughly $260 today. You cannot buy Visa privately. It is a public company. Mastercard, same situation. American Express, also public. The 4 major networks are all public companies. The window to own the rails closed when the initial public offerings happened. The smarter route, the one that actually still works, is acquiring a co-brand partnership. When a hotel chain or airline says their card gives you points, there is a bank sitting behind that card issuing the credit. The points are the hotel's viability. The bank earns the interchange. Those partnership contracts, the economic rights to issue a specific co-brand portfolio, trade privately. United's co-brand partnership with Chase was estimated to be worth $7 billion as a standalone asset in 2021. You can buy into that structure. Most people do not know it exists as a purchasable asset. The one thing you cannot buy, regardless of how much money you have, is a new network license. The payment network business requires decades of merchant acceptance, cardholder trust, and regulatory relationships. Nobody has successfully launched a new general-purpose card network in the United States since Discover in 1985. That is not a coincidence. Before your first transaction is processed, before your first cardholder swipes anything, the cost of existing in this business is enormous and almost entirely invisible from the outside. If you own an issuing bank with a $2 billion card portfolio, your cost to simply exist, no new cards issued, no growth, no marketing, runs approximately $11 million per month. Call it $360,000 per day. Here is where that goes. Funding cost. You borrowed the money you lent to cardholders. That costs you. At current rates, funding a $2 billion portfolio costs roughly $80 to $100 million per year, just in interest expense to the institutions that lent you the capital. That is before a single cardholder pays late or defaults. Fraud losses. The average card portfolio loses $2 to $4 million per year on $2 billion in balances, running continuously, whether or not you are doing anything particularly wrong. Regulatory infrastructure. A bank charter requires compliance teams, risk officers, call centers for disputes, card replacement programs, and a fraud operations team. None of that is optional. The minimum regulatory infrastructure to run a card portfolio at this scale costs between $12 and $20 million per year before you pay a single person who actually talks to a customer. The trap is the cheap option. Smaller portfolios do not scale the fixed costs down proportionally. A $200 million portfolio pays almost the same regulatory overhead as a $2 billion portfolio. The economics only work when the interest income and interchange revenue cover a cost base that barely moves regardless of how many cards you have outstanding. Think of it like a toll road. Every time a car passes through, the toll operator collects a fixed fee. The toll operator does not care where the car is going, what it is carrying, or whether the driver is wealthy or broke. The car passes, the fee is collected, the road earned. That is the card network business. When your cardholder buys a $100 dinner, 4 parties are involved in approximately 1.4 seconds. The cardholder's bank, that is you, the issuer, approves the transaction. The merchant's bank, the acquirer, receives the instruction. Visa or Mastercard sits in the middle routing the message. The merchant gets $98. $2 stays in the system and gets divided among the parties. That $2 is called interchange. The issuing bank, U, keeps approximately $1.60 to $1.80 of it. Visa collects approximately 7 to 12 cents. The acquiring bank keeps the rest. Here is the inversion. Everyone looks at the interest rate, the 21, 25, 29% annual percentage rate that goes on a credit card, and assumes that is the profit. It is not the only profit, and for the best-run card businesses, it is not even the primary profit. The people who pay interest are the people who carry a balance. They generate enormous revenue, but they also default. Charge-offs in a standard consumer card portfolio run between 3 and 5% of balances annually in a good economic environment. You are collecting 25% interest on one side and losing 3 to 5% of principal on the other. The math works, but it is not as simple as it looks. The people who never pay interest, the ones who pay their balance in full every month, the ones the industry calls transactors, generate almost no interest revenue. They generate interchange. Every time they use the card, they are generating $1.70 of risk-free income for the issuing bank. Risk-free. They never default. They have excellent credit. They spend at very high volumes. The premium rewards cards, the ones with the $250 annual fee, exist entirely to attract this customer because that customer's interchange income over a lifetime exceeds almost any revolving customer's interest income over the same period. The business that everyone thinks is a lending business is, in its most profitable form, a transaction business. The profit is not in the interest, it is in the rails. 2 ways this business ends. Failure mode. 1. The credit cycle. CompuCredit Corporation, Atlanta, Georgia, 2007. CompuCredit had built a portfolio of approximately $4 billion in subprime credit card receivables, cards issued to consumers with poor or no credit history at interest rates of 29 to 36%. The model worked as long as unemployment stayed low and consumers kept making minimum payments. When the 2008 recession hit, CompuCredit's charge-off rate went from approximately 6% to over 15% inside 12 months. They lost $730 million in 2008. They sold the portfolio at a loss. The Consumer Financial Protection Bureau later fined them $210 million for deceptive practices. The charges included hiding fees in the fine print and marketing cards to consumers who could not afford them. Chairman and Chief Executive David Hanna left the company. It was restructured and eventually renamed Atlanticus Holdings. The original equity was substantially destroyed. The mechanism was not complicated. They lent to people who could not absorb an economic shock. When the shock came, the losses exceeded the interest income accumulated over years of operation. The math only worked during the expansion. It never worked in the contraction. Failure mode 2, merchant revolt. The interchange war. In 2011, the Durbin Amendment to the Dodd-Frank Act capped interchange fees on debit card transactions at approximately 21 cents per transaction, down from an average of 44 cents. Overnight, the debit card interchange revenue for issuing banks dropped by approximately 50%. The issuing banks that had built their debit card economics around 40+ cent interchange had to restructure entire businesses. Free checking accounts disappeared within 18 months. Free checking, as it turned out, had always been an accounting trick. Monthly maintenance fees appeared on accounts that had never charged them. The banks had been subsidizing free banking with interchange revenue. When the interchange was cut, the subsidy ended and the cost was passed to consumers. The lesson is that the fee structure you build your business on is not permanent. It is a regulatory decision. It can be changed by one amendment to one bill, signed in a single afternoon with 6 months implementation time. The profitability of the most capital-light card business in the world is, in the end, a political question. The threat that your finance team cannot model is not a credit cycle or a regulatory cap. It is the end of the network itself. The Federal Reserve's FedNow system launched in 2023. It allows any bank to transfer money in real time, 24 hours a day, 7 days a week, at a fraction of the cost of card interchange. That is exactly what a card network does, except FedNow charges roughly 4.5 cents per transaction. Visa charges merchants around 2%. On a $100 purchase, that is the difference between 4 cents and $2. Every merchant who routes a transaction through a real-time payment system instead of Visa saves the interchange fee. Every dollar that moves that way is a dollar your network does not touch. The merchants have always known this. For decades, there was no alternative infrastructure capable of handling the volume. Now there is. This is not a hypothetical. China mandated Union Pay for domestic transactions and effectively excluded Visa and Mastercard from the world's largest consumer market for years. India's RuPay network now handles over 50% of domestic card transactions. Brazil's Pix instant payment system processed over 40 billion transactions in 2023, most of them at near zero cost to merchants. Your card network earns a fee every time money crosses crosses through your rails. If governments decide the rails should be cheaper or build their own, the fee does not shrink. It disappears. Not the margin, the fee, the entire revenue model. The rails are the asset. The risk is that someone builds better rails and charges nothing to use them. 2 scenarios for your $2 billion card portfolio. Optimistic. Your portfolio generates an average yield of 17.8% annually on outstanding balances. That is $356 million in gross interest income. You collect interchange on approximately $4 billion in annual purchase volume. That is $65 to $70 million. Total gross revenue comes to approximately $425 million. Subtract funding costs of $95 million, credit losses of $60 million at a 3% charge-off rate, operating expenses of $120 million. Net income lands at approximately $150 million on a portfolio you acquired for $400 million. That is a 37.5% annual return on your equity. Assuming reasonable leverage, you have paid back your acquisition in under 3 years. Realistic. Charge-offs run at 5% in a mild recession. That is $100 million in credit losses instead of 60. Funding costs rise as interest rates stay elevated. Your net income falls to approximately $80 million. Return on equity drops to 20%, still exceptional by almost any standard. Payback period extends to 5 years instead of 3. The person who built the better version of this business was not a banker. Kenneth Chenault ran American Express for 16 years. He did not compete with Visa on interchange rates. He built a closed loop, a network where Amex acts as issuer, network, and acquirer simultaneously, collecting fees at every point of the transaction that other networks split 3 ways. When Chenault retired in 2018, American Express had grown its earnings per share from $3.81 to $6.58 over his tenure through 2 major recessions. He understood something that the issuing bank tier never fully internalizes. The money in this business is not in the credit. The money is in controlling the infrastructure through which the credit moves. The interest rate is what everyone sees. The interchange is what everyone earns. But the network, the relationship between every merchant and every cardholder that makes the card worth having, that is the thing that compounds forever. At the start of this, you had to decide whether you wanted to be the bank or the railroad. Chenault looked at that question and built a third answer. He became both. And then he charged the banks a fee to use his tracks.